Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, April 19th, 2021. And our top stories today, managing lower than expected returns for those closer to retirement and making the most of record savings in 2020. Well, joining me now to discuss this and a lot more is Katherine Roy. She's a managing director and chief retirement strategist for JP Morgan Asset Management. Katherine, great to see you. Thanks so much for joining us on the program this morning.
For having me. It's great to be here.
Yeah, it's great to talk to you. And JP Morgan publishes something called the Guide to Retirement, which I think is as popular, or if not more popular, than its guide to the markets. Not trying to create any competition with you and Dr. David Kelly, but this is really timely information. And I thought we'd start, in looking at the report, looking at some of the information. Let's start about managing these lower expected returns that we can expect in retirement. What can you tell us here?
Yeah, so we just published our 9th guide, which is really exciting. But as a part of that publication, we always take a look at our best thinking as a firm with our long-term capital market assumptions to try to give guidance around what is a relevant or probably a realistic pre-retirement rate of return. And as we did that this year, it was our 25th year of publishing those long-term capital market assumptions. We really were challenged in terms of the returns we can expect over the next 10 to 15 years or so. So we reduced our pre-retirement rate of return from 6%, where it had been for the last probably 3 or 4 years, down by just a 0.25% to 5.75%. And that's really the return we would expect a 25 to 65-year-old over a very long period of time to be able to achieve. And what's interesting, whenever we do that within the guide, we always look at our checkpoint chart, which is a multiplier chart that's intended to help people, based on their age, understand relative to their household income, how much should they have today to be on track to afford their retirement. And when we change the rate of return, it really doesn't impact younger people in that chart, so a 20 to 45-year-old or so. And that's really because savings is the biggest contributor to how their wealth is growing. But once your wealth gets to be more significant, that rate of return reduction can have a pretty significant effect. So, this kind of challenged long-term returns over the next 10 to 15 years really impacts people closest to retirement when they have the most wealth at risk, or the most wealth that really needs that return to be able to successfully get them across that finish line. And so when we look at the average participant, we see that means, just that 0.25% change for a 65-year-old. If that average participant we see, leaving the workforce at about $80,000 of income, that's a $60,000 difference in terms of what that 65-year-old needs. And so, we want to make sure that people are aware of that when their wealth is greatest, obviously they need strategies to protect that wealth as well as grow it, but also how important it is to save in those last years, ramping up to retirement as well.
Well, one of the big topics in our industry is retirement income. We had the passage of Secure Act, which was the implementation obviously abruptly disrupted by COVID and the CARES Act. But what does this mean for expected retirement income? What does this mean? Does this mean that people may have to work longer? Does it mean that they have to contribute more? When I was coming up, we were talking beforehand, when I was coming up through the ranks and I had hair and I was doing record keeping, it was an 8% return. And you've seen this continued decline. So what does this mean for expected retirement income, and are there ways to mitigate this?
Yeah, I think you're absolutely right. When I started at JP Morgan 10 years ago, our capital market assumption would support that 8% return, and gradually it's come down. Now we would say that a 60-40 portfolio is more like a 4.2% return, which is a drastic reduction. And so what it means for people in retirement is, number one, they need to invest. And so when we look at the 4% rule, the infamous 4% rule, and we look at what if someone just holds cash, which we know there's a lot of cash on the sidelines right now, we see that that's not successful. That level of lack of investment, right, is not going to support that level of spending. So you need to remain invested in retirement to be able to support that level of spending you're going to need, particularly because healthcare costs on Medicare we see growing at about a 6% rate. That's inflation plus the fact you buy more of it as you get older. So you need to have some growth in your portfolio. And what we see as a potential solution with our assumptions really is the importance of diversification. So when we compare a 40-60 simplistic portfolio that's invested in the ACWI as well as U.S. aggregate bonds, It barely makes the 4% rule successful at an 80% confidence level. But when you diversify within those asset classes, adding some high yield bonds, adding emerging market equities and debt in the equity side, the more diversification, slightly more risk, but that leaves about $200,000 left on that $1 million initial portfolio for that 4% rule, which is a significant cushion above kind of this risk of potentially running out of money. So diversification we really see as being very important, not just to retirement, but through retirement.
When you look at target date funds, which are by and large have been, as long as I can remember, I mean, since even before the passage of the Pension Protection Act in 2006, those have seen a huge swell of assets. JP Morgan, other providers have been have received a lot of those assets. For those invested in target date funds, is it important that there is a diversified portfolio within the target date portfolio, that it's not just, as you suggest, the basic asset classes, that you're looking at things like high yield? Just want to give people a little bit of a sense of how target date managers maybe adjust their allocation to some of these capital market assumptions.
I think diversification is always something we've believed in, and so we see it only becoming that much more important, going forward. And so I would say that it's important from individuals who are in target date funds to be able to benefit from that higher level of diversification. The question I think we raise is, are the people who could benefit from that the most actually in the target date fund? Because when you look at target date fund adoption in plans, you see a lot of do-it-yourselfers in the 50 plus segment, and we see them carrying a significant amount of risk. And really, I would say they're barbell. They either have a significant amount of risk relative to any of our glide paths, or they have a significant amount of cash. And so both of those we really see as suboptimal. And so what we want to ask plan sponsors to think about, and advisors, is as you're looking at and choosing your default investment, like that target date fund, it's one thing to choose and make the right decision for your plan, but it's another to make sure that the people who will benefit from that decision the most are in it. So thinking about re-enrollment, particularly for those households that are closest to retirement, where this higher degree of diversification or the right level of risk is really important, given the challenges that we might face over the next 10 to 15 years, re-enrollment would help reposition, that participant maybe on a better path than they're on their own.
Yeah, last question for this segment, Katherine. Pension funds have access to a broader range of asset classes. These would be things like alternative investments, hedge funds, private equity. They can add it to their portfolio. They've got a lot of times have a longer time horizon, but they have capital needs as well. What about the personal investor? Some of those do-it-yourselfers you mentioned, people out there, part of that barbell, they're out there allocating. Are you seeing more interest in possibly adding some of these non-generic, for lack of a better term, asset classes to retirement plans or to IRAs for consideration?
So I think we see, value in having some of those asset classes in plan. We have in our target date series a version that has direct real estate, and that's been really additive to its performance. But there's costs that comes with that, which obviously is a challenge in plan, where fees are such an important consideration, and there's liquidity constraints that make that often a challenge to do within defined contribution plans. So I think for those two reasons, even though there's been some direction as to those types of asset classes being attractive, I think those challenges remain very real as plan sponsors and advisors think about this, as well as us as investors. So, but I do think on the private wealth side, clearly alternative asset classes is an area where, for the right type of wealth level, holding some in terms of percent of the portfolio of those types of asset classes is an additional asset class that leads to that greater diversification, which we would say would also produce a better outcome for that type of client.
Well, Katherine, we're going to take a very quick break. When we come back, we'll talk to Katherine about making the most of those record savings in 2020. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Katherine Roy of JP Morgan Asset Management. Katherine, thanks so much for staying with us this morning.
Thanks for having me.
Let's talk about some of this record savings. So a lot of people, obviously with the quarantine, one of the downsides, obviously a lot of downside with the pandemic, people being home, loss of life, healthcare. But one of the upsides has been pent up savings, people just putting money away. I would think, Katherine, this is overall a really good thing. And for those of us in the retirement savings segment of the economy, this is something near and dear to our hearts.
Yeah, I think I was really pleasantly surprised when we looked up the 2020 national savings rate for the United States and we hit 15% for the very first time. And interestingly, that 15% is the JP Morgan recommended savings rate to successfully get to retirement with all the curveballs that can be thrown your way, to successfully get to retirement with enough wealth left to be able to afford your retirement lifestyle. So while I was really thrilled to see us hit that, and we had to rescale the graph in our guide to retirement to be able to accommodate that, we had a lot of help. And so when you look under the covers and see, well, what were the real drivers of why America saved so much more? And when we say that 50% savings rate, it's really an aggregate view of all the income, all of the government transfers, less taxes, less your spending, what was left over at the end of the day. And so as we know, 2020 was very unique. And so we estimate about 2/3 of that incremental savings came in the form of the fiscal stimulus checks that were distributed in that year, as well as the unemployment, additional unemployment assistance that was being given by the federal government. So that's 2/3 of it. 1/3 comes back to what you mentioned, and that is reduced spending by about $500 billion, which is really significant in terms of the U.S. consumer contracting because of those stay-at-home orders, right? Fear for health purposes. And so as we think about moving forward, I think we can hopefully identify, some things we reduced our spending on, which we need to get back to. So I'm thinking, medical appointments, dental appointments, those things that we really did see contract as well that aren't good in the long run. But if there are areas where we have some discretionary spending that we didn't miss spending, that being thoughtful really can help us potentially save more going forward, redirect some of that thoughtfully as a result of learnings from 2020, save more going forward. And then from a retiree perspective, as things get rocky, we know one of the big levers retirees retirees have is to reduce their spending or maybe not pull from their portfolio as much, that can be also, important for retirees as well.
Katherine, the behavior that we saw during the pandemic, is there any indication that, I think people learned a lot about managing their finances. This was a horrific experience on so many different levels. And this has a tendency, we saw in 2008 with certain generations, it has an imprint on the generation. Does this have a behavioral imprint so that once things return to some level, whatever that new normal looks like, that people will take the lessons that they learned, realize they need an emergency savings account. They need to make sure that they're thinking about not only today, but tomorrow, for their families, for their own financial security. Does this have that type of impression that the Great Depression maybe had on the parents of the boomers?
I think we're hoping so, just from that emergency savings area that you mentioned. We know Americans have been challenged to be able to have that short-term liquidity that they need to protect them against unexpected events. And if we think about 2020, there were a lot of unexpected events, whether it's the market volatility or COVID to begin with, right, is something that couldn't have been planned for. So I hope a key lesson that is imprinted, to your point, is the importance of that emergency reserve. And so we're kind of happy that we see only about 6% of retirement plan participants, in a position where they were affected by COVID and had to take advantage of the CARES Act provisions to tap their retirement plans. I think we're hopeful that they'll use the next 2 years to pay that back. We're really happy that that provision was put into the CARES Act to give that opportunity to get back on track. So yes, I'm hoping there's a good learning from that emergency reserve. I think you're seeing from a stimulus check perspective, there's been some discussion that a majority of the millennials will actually save and invest those dollars, which we think is great and could move them in the right direction. And then obviously the liquidity helps people pay down high interest rate debt, which is so important and can be also a barrier to saving for retirement. So I think, if people can identify those areas where they could be saving more going forward, our hierarchy obviously is that emergency reserve, right? Having that near-term liquidity to protect your long-term savings, maximizing the match to get free money from your employer, whether that be in an HSA or a defined contribution plan, then thinking about paying down that high interest rate debt really is an important sequence for people to be considering when they have these additional dollars.
Katherine, what about employers? I mean, so much of the focus of the last year and a half has been keeping the lights on. It really hasn't probably been strengthening the retirement program, although they probably did have their regular due diligence meetings, most likely through Zoom or some other technology, nothing in person, of course. But what about things like bolt-on services like financial wellness, advice? Do those take more of a priority as that return, that reopening happens, and we kind of get back to whatever this new normal is? In these committee meetings, they say, okay, we learned some lessons as fiduciaries about managing our plan. Our business is sound. Now let's focus on improving the outcomes, the retirement outcomes, and the financial security outcomes of our employees.
Yeah, so I would probably start with, plan sponsors that had the biggest impact, were impacted the most in terms of those that took action to either reduce or suspend their company match. And we did see a number of them do that, usually at the smaller end of the employment scale. And the good news there that I take away from our research is that participants stayed contributing. So I think the good news through 2020 is that the 401k system works, that participants continue to contribute at a very high level, very few changed their contribution habits, and they stayed invested. So we saw only a very small number of participants actually change their investment direction. And that really means that, again, that inertia that is so valuable in the 401k system is working through periods of turbulence like we saw in 2020. So what we do see is that those employers that maybe reduced or cut their match, when we look at their participants, they stayed contributing. And so we know the max is a good anchor in terms of helping participants decide how much they're going to contribute. And so as those plan sponsors reinstate their match, what we'd encourage them to do is to think about a stretch match option. So we know that if they kind of raise that and encourage participants to save to a greater degree themselves to get the same level of money, that's something that's great to introduce after there's been an interruption, because participants, likely will reset and rethink about how their own contributions need to increase as well as a result of that match change. So I think that's first and foremost. And then I think second, you're right. I think the wellness programs, we increasingly see, through our JP Morgan Chase activities, that the employer is such a powerful place for people really to get their finances on track. And a majority of individuals would love to see, and a majority of participants would love to see an emergency reserve option available to them through their employer, really to help them build that liquidity through that regular paycheck contribution in a way that makes it easy for them. So I think not just a wellness program where it's educational, but something that puts a strategy into practice and makes it easier for that participant to be doing those activities, we think is really important as well.
Well, all good news, really good news in light of what's happened. Great to see people saving. Hopefully they'll continue that. Katherine Roy, it's been an absolute pleasure talking with you this morning. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thanks so much.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse, and of course, our website. We're back again tomorrow, so until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.